Welcome back. So last month, the Bank of Canada opted to hold its benchmark interest rate steady at 5% after 10 hikes since March of last year, citing a slowing economy and a bump in unemployment. Another report on inflation and more data are expected before the central bank meets again on October 25th to discuss the potential for further hikes. Now, the big question, is this the best way to tackle inflation by going after the purchasing power of ordinary Canadians? And how does it affect you? Let's get into it. Avi.
I want to pick up on something Jim said at the end of the last segment, which is that he offered different reasons for inflation other than the traditional one that it's an overheated economy, because that's traditionally what central banks look at, and that's what policy has been based on in the past. So I agree that the causes of inflation this time are not an overheated economy. However, in defense of the central banks, given their mandate, have a very small toolkit. And basically, it is the interest rate. It's a very blunt instrument. So that in terms of what can the central bank do to try and tame down inflation, really their only tool is to raise interest rates in an attempt to slow down the economy. The other reason that I would say that that is a defensible policy, and maybe this is going in a direction we don't want to go now, is that central bankers are really worried, and they are rightly so to be worried, about inflation expectations becoming entrenched, where people expect prices to go up, therefore they ask for more money, businesses raise their prices because they know they're going to be able to, and then it becomes a self-fulfilling prophecy like it was in the 80s.
And if you look at the U.S. Fed, they have a dual mandate, which is they want to hit that 2% inflation target, while at the same time they want to have full employment. Well, we're kind of at the point now where we have full employment, and all they have to do is hit this 2% target now, but it seems like they can't do both, or at least that's what they're saying. And so there's a bit of contradiction there in terms of the mandate, and you have to look broader at both fiscal policy and monetary policy as two separate things. And so what should governments be doing to address inflation? I think there's a number of items at their tools at their disposal, which they should be looking at. And the central bank, like Avi said, they only really have one tool, and that's the interest rate.
Jim, do you agree?
Well, a couple of points. Number one, I do not think we are at full employment. Our unemployment rate in Canada now is 5.6%. It fell to around 5% at the best times after the pandemic, and that's lower than it has been in the past. But that isn't full employment. That's still 1 million people officially unemployed. There's probably 1 million more working part-time who would prefer more hours. And there's probably another 1 million more on the margins of the labor market, people who say they'd be interested in working but can't find a job that fits their family responsibilities and so on. So I think we're a long ways from full employment. And the idea that 5 or 6 or even 7% unemployment equals full employment is a kind of a semantics game that central bankers have been playing for decades. They call this the natural rate of unemployment, or the non-accelerating inflation rate of unemployment. Fancy terms to try and justify ongoing unemployment as a normal feature of the economy. And I think it's wrong to accept that. So in that regard, I think that assuming that the only thing we can do is raise interest rates is wrong. You're right. That is the main tool in the central bank's playbook. They do have other levers. There is quantitative easing and quantitative tightening. And then they can also work with financial regulators around things like prudential requirements on mortgage credit, et cetera. But by and large, the Bank of Canada just uses the interest rate. But there's other things government can do to challenge inflation as well. Everything from price regulations in key commodities like housing or energy to fiscal transfers to try and shift some of the excess profits that companies have made out of inflation back to the consumers who are suffering.
Do you think we'll see another hike again before the end of the year? Jim?
I do think we will, yes. The Bank of Canada paused last month, but it's what has been called a hawkish pause. That means, okay, we're holding it for now, but we're ready to increase again if it looks like our preferred measures of inflation are going in the wrong direction. And right now they are. Again, not because too many Canadians are working. They're going in the wrong direction because energy prices are going back up, because OPEC and Russia are constraining supply, and all of that is passed on directly to consumers through the oil and gas industry here. So for reasons that have nothing to do with typical Canadian conditions, we are seeing higher inflation, not lower, despite higher interest rates. And that's why I think we're going to see another increase.
And that's just it. Canadians are paying the price. Sylvain, let me bring you in here. Why is there such a gap between food inflation and regular inflation? And why is food slower to respond to the interest rate?
It's the nature of the business. It's a high volume, low margin environment, unlike many other sectors. So there is a lag time before food responds to macroeconomic shifts. That's one thing. The other thing is that industrial prices are actually much higher. In fact, the IPPI has outpaced the CPI since 2020, the last 3 years. So pressures up the food chain are real. And so consumers have been hit with higher food prices, but unfortunately, it's not over. So we are expecting food prices to continue to rise at a much lower pace, though, but we are expecting food prices to continue to rise despite what's going on with inflation in general.
Yeah. Just finally, what are other central banks doing?
Most other central banks are doing exactly what the Bank of Canada is doing because they have similar mandates. And
Well, I've heard the Bank of Canada was more aggressive in its approach.
The Bank of Canada, Canada was one of the first central banks to adopt inflation rate targeting in 1992. And other central banks have followed along ever since then. And I think they're very committed to the idea of that target and keeping expectations anchored on that target. So that would imply that you would be a little bit tougher in terms of where you set the interest rate, as in higher.
All right, quick break. Next, we're sharing practical tips on managing your money amidst rising interest rates, especially when it comes to mortgages. Stay with us.